Alright, what I need everyone who sees this video to understand is that in Forex, and really in any financial market that you can trade on an exchange, on exchanges, like day trading, you know, price moves at certain levels. Okay, so let's take for example the pair that I trade, which is GBP USD, Great British Pound versus the US dollar, foreign exchange currency pair. So we'll take for example certain levels. So you have like the 1.0, that's at the very bottom. Then you have 2.0, that's at the very top. Okay, like it's trading in between those two, that area, right? And then the halfway point there is 1.5, right? So those are the major three levels, the biggest three levels right there. So obviously the 1.0 and the 2.0 are the two. It doesn't get any bigger than that as far as levels go. And then you have the 1.5, which also would be the second biggest level, period. And then in between the 1.0 and the 1.5, you have the 1.25. So that's going to be the 1.25,000 level. And then in between the 1.5 and the 2.0, you have the 1.75 level. That's going to be the 1.75,000 level. And those are the major levels, the biggest levels. So you've got the number one, number two biggest level. Number one biggest level will be 1.0, 2.0. Second biggest level will be the 1.5. The third biggest levels will be 1.25 and the 1.75, right? So you see we're just dividing everything in half. Okay, and then if you go in and you start dividing everything by 10,000, right? So let's say, just for sake of simplicity, you start at 1.1, right? So that's 1.10,000. And then you divide that by the next level, which is 1.2, right? So you got 1.1 and 1.2, so those are 10,000 levels. Now those are your fourth biggest levels that you have, 10,000 levels, price levels, right? So the actual price would be, you know, 1.100000, right? And then 1.20000, right? So you have 1.10,000 and the 1.20,000. The same thing, you divide that up. So you have 1.15, right? So that's your fifth biggest. So we have one biggest level, 1.0, 2.0, second biggest level, 1.5, third biggest level, 1.25, and 1.75, and then you go down to smaller time frame, which is still huge, still a very large time frame, even on the daily or the weekly, but daily. Now you're talking about, so you got 1, 2, 3. Now you're talking the fourth biggest time frames are going to be your 1.1, which is 1.10,000, and then your 1.2, which is 1.20,000. That's going to be your fourth biggest levels. Okay. Now in between there, like I said, the 1.15, that's going to be your fifth biggest level, and then your sixth biggest level is the 1.1 to the 1.1. Did I already say 1.15? Let's see, 1, 2, 3, 4, 5. Yeah, so your sixth biggest level is going to be 1.125, which is halfway between 1.1 and 1.15. Okay, so that's your sixth biggest level. Also, right there with it is the 1.175, which is halfway between the 1.5 and the 2. The 1.5 and the 1. 2. So that's your 6th biggest level. And those are going to be your major quarter levels. Okay, that you're going to want to look at on the higher time frames, like your daily, to get your daily analysis, or your daily candlesticks. A daily candlestick is just all the price action for the day charted and plotted on the chart. So that means you're going to have an open price, and then you're going to have a low, and then you're going to have a high, and then you're going to have a close. Now that's on a bullish candlestick, right? Now, next candlestick over, if it's bearish, you're going to have an open, a high, a low, and then a close, right? And then that's how you get your body for the candlestick, is the open and close price. And then your highs and lows are where you get your wicks from, or those things that are poking out of the vertical rectangular formation. Okay, it's important to know and to understand how the price moves, right? So when you see the candlestick, you've got to get used to visualizing, okay, the candle, it opens here, it has a low, and then it has a high, and then it has a close. And then the next one, it has a high, and a low, and then a close. And then in that way, you can get the flow of the momentum of what's happening, what's going on. So anytime you're looking at price action, you need to look at the higher time frames, look at how the candlesticks are forming, what happened. Like if it went down real quick and then it came back up, it zips up, well, a lot of things could have happened. It could have been somebody dumping a position, and for whatever reason, and then people saw that good price, and then they just bought, and then it zipped it up, and then now you've got that kangaroo tail. Or it could be a level where you had previous lows on a resistance level where people were buying, and then on the GBP, a lot of times what will happen is it'll go down and take those stops out from the people who were buying. They set stop losses so that they wouldn't lose money, or a lot of money, right? So they were trying to minimize the amount of money they would lose. So then what will happen is price will go down a lot of times and slam in to those stops and take those stops out. And then what will happen is, as soon as the stops are taken out, it creates liquidity in the market, which large money takes, uses, and buys that up, and then that's when you see the zip up, right? And as prices moving up, also too, you'll see, sometimes price will be helped by people who are selling at certain levels. Well, the buyers just buy that up, and then it just keeps going, and then eventually their stops are taken out. And there's a lot of different things like that can happen that can create liquidity in the market. But the main thing, the reason why I explained to you the levels is, so it's important to understand the candlesticks and the candlestick formations and what they mean. Understand, so there's basically two types of candlestick formations that you need to know. The big ones are reversal patterns, right? But I think even more importantly, because most of the time, you want to be trading in the trend if you can, are continuation patterns. So learn what the continuation patterns are, learn what the reversal patterns are. Unless you see a reversal pattern, you have to assume that the trend will continue, and then you may see a consolidation, but you need to be able to recognize what's going on in that consolidation, where you are in terms of key levels, and the things that I explained to you at the beginning of the video are called quarter levels. And the reason they're called quarter levels is because they go in like 250 chunks and 500 chunks and then 1,000 chunks, right? So they're divided into quarter chunks, right? And so you can go as far down as you want to. We talked about the 10,000 level, but then within the 10,000 level, you can go on the 1,000 level. So that would be like 1.11000 between that and 1.12000. That's 1,000 points or 100 pips, and you divide it the same exact way. So I think we're on number 7 of the weight of the importance of the levels, that would be like, I think 7. I lost count already. I would have to go through and write it out on my whiteboard. But yeah, so that 1.11 and then the 1.12, and then in between would be 1.115, right? That would be your next important level. And I color code these. I do the most important ones, the round numbers, like the 000 ones, I do those in red, all of them. The higher time frame, like the 1.0, 2.0, I would do as thick as possible. And then I would do the 1.5 as thick as possible in orange. So I would do the 1.0 in red, the 1.5 in orange as thick as possible. And then on the next level, that's the 100,000 basically, something like that. But and on a 10,000 level, I would do the same thing. I would use red on the 0 ones, on the even those major ones, and then I would do that a little bit less thick, noticeably less thick, but still thick. Same thing on the 1.15. I think I'm explaining that right, yeah. And then also too, then you go down a little bit less thickness on the 1,000 level. So you've got like the 100,000 level, right? Because it's 10,000, and then the next level above that is 100,000, right? This is the 1.00000, right? That's 100,000. So that's 6 digits. You got 1, and then 5 digits, 100,000, yeah, 100,000 level. So and then going down to the 1.11000, then you go, like I said, that's like a little bit less thick as you go down. Same color coding, and then the actual quarter levels themselves I just do in yellow. So that would be like the 1.25 and the 1.75 and the 1.125 and the 1.175, and then 1.11250 and then the 1.11750. Those in yellow. So the only 3 colors that I use: red, orange, and yellow. And then sometimes you can do what's called 125 levels, which are not really quarter levels, but sometimes they can be useful just because you can watch what the price is doing at those levels. You don't really want to buy or sell at those levels if you can help it, but you want to pay attention to what's going on. You can, depending on what the price looks like if you get a really bullish candlestick, if you're trying to buy, or you get a really bearish candlestick and you're trying to sell, you can do that at your own risk, whatever you think. But so let's get to, and now I want to explain real quick, those levels, price tends to move back and forth between those levels, and if you see, so let's say we're talking about the 1.11000 level. Okay, so let's talk about that. So let's say price starts there, and it goes up, and it explodes through the 1.11500 level. What'll happen oftentimes is, before it continues moving, especially if it moved a little bit too fast, it'll come back and test like the quarter level, like the 1.11250, and then it'll go back up, right? And so that's the thing. Whenever you want to try to get in, like, so say you're trying to buy, say you're trying to go long, well, you want to always try to get in below whatever the next level that it looks like it's pushing to, right? So in other words, if it pushed through the 1.11000, then basically what will happen a lot of times is it'll come back and it'll break back through, and then it'll either test that 125 level or the quarter level, and then it'll go up. So what you want to do is, if you can, in order to minimize drawdown so that you're not in drawdown. Now, drawdown is just when you enter a trade, like say you enter a buy trade, and then it goes against you before it goes up, hopefully, right? Hopefully it goes up, but it just goes against you. Now you're in drawdown. So if it keeps going either hit your stop or blow up your account. But the goal is to be patient and to minimize drawdown. Now, I will say, one of the things to watch out for, because trading, you have to have the knowledge and the right knowledge, but it's like 90% psychology or more, because FOMO, the fear of missing out, is so powerful. What it can happen is it can cause you to be impatient, it can cause you to enter way too early, it can cause you to be in drawdown way too long, it can cause you to lose a lot of money, take a lot more risk than you need. So that's why I'm saying, if you can get in below a major level that you think, like, let's say you're using, we'll talk about indicators in a minute, but let's say you're using stochastic oscillators and they all indicate that price is going to go up, right? Like, say it's oversold. Now price busts through the 1,000 level, and it came back down, and it busts through looking like it was not really going to keep going up, but you know better because you've studied the candlesticks, or it's just a bullish uptrend long term. I don't want to confuse you, but like right now, Great British Pound versus US dollar is in a long-term downtrend, right? So basically, what it'll do sometimes is it'll go down, because I'm changing from, I was just talking about buying to selling, but a lot of times it'll go down to a 1,000 level and then it'll come back up, right? But you know that the trend, long-term trend is down, so you look for something else we haven't talked about yet, is trend lines, right? So trend lines are, just basically tracking the highs of a downtrend, right? So you're looking for it ideally to come up and touch a downtrend trend line at a key level, and depending on where you are in those key levels, because price tends to move from 1,000 level to 1,000 level. Like say you got a 1,000 level here and a 1,000 level here. Well, price a lot of times will come down and it'll come back up, and then it'll come down and it'll complete that 1,000 level, right? So you can use a lot of different things. You can use, you need to be using all these things, quarter levels, liquidity zones, to be aware of those, and trend lines, and also the candlestick formations and the candlesticks themselves. Like a lot of times you can go on the 4 hour and you can look at what the candlestick looks like, or the daily or something like that. But most of the time you're going to find your formations either on the hourly, or maybe the 30-minute or 15-minute or 5-minute. I would recommend most likely be careful on the 1-minute chart. You don't want to be spending too much time on there. I did that before, and that doesn't mean you shouldn't look at it. You get little sniper entries and stuff, but for the most part, and a lot of times on the stochastic oscillator, that the 1 minute can be a tipping point for like the 5-minute. Like when the 1 minute starts to go after a certain amount of revolutions, then the 5-minute. And what I'm talking about is the stochastic oscillator as an indicator. Stochastic oscillator is probably the only indicator that I've used the whole time. Now, I have used volume most of the time. I didn't really know why at first. I just thought something I should do, to sort of see like when the most active times were to trade, and kind of like how much the volume was right now, to see if it's worth it even to be in the market at that time. And if you're in the right place at the right place, period, on the chart, anytime's a good time to get in at a good price. At like I said, the optimal point of confluence where you have a key level, a trend line, either like a bearish candlestick. Say you got a bearish downtrend with a bearish trend line, with a bearish candlestick, with a bearish formation on a smaller time frame. Like you may see a bearish candlestick on the 4 hour or the daily or something, and then you may see a formation with close to that candlestick on a smaller time frame, like the 5-minute or the 15-minute or something like that, or maybe even the 1 minute, I guess, if you want to go down that far. But and then you also want to be aware of liquidity zones, because it doesn't always come back to grab liquidity, but a lot of times it will, especially before a major move. Now, if you're due for a major move, but the market is struggling to go down, that's a warning sign to say that the market makers or whoever's in control of the price, whoever's kind of controlling the action, the big players, the big dogs, the guys with a lot of money, they're going to understand, hey, there's not enough liquidity here to go down where we want to go. Like, you know what I'm saying? So a lot of times what will happen is you'll see that market zip up, and then everybody gets stopped out. Everybody's out of, these small traders are out of money, but that gives liquidity into the market. Now the big dogs are going to come in and start hammering that price down to where, a lot of people already knew it was going. So that's what I was talking about. FOMO, fear of missing out, patience, all of that. So, it's a lot of stuff to trading. It's not something that's easy. You see it like, you're like, price is just going up and down. This is easy. I can just buy here and sell there and no big deal. But it's a lot more to it than that. And I know everybody says that, but it's true. And then you want to pay attention to fundamentals. Now, fundamentals aren't something that I really understand because I don't come from a economic background or an economic education, but it's something that we should try to understand at least. It's something that we should study on and try to get a grasp on economics, world economics, the economics in our country, the economics in the country of the currency pairs that you're trading, and to know, like, okay, so basically you have a major news release coming up. Well, you can look up the news on that, articles written by economists who know what they're talking about, and then you can read what it means for the economy. You got things like GDP, gross domestic product. You've got things like what's the PMI, the manufacturing index, and you got the CPI, consumer price index. You've got the interest rates. You got so much stuff out there that's important to pay attention to. But here's the thing: it's usually going to be reflected on in the market, and you can usually tell where the market's going just based on price data, the chart data alone. So learning to read the charts and spending time on the charts, it's like learning another language. Like if you were going to learn Chinese, the best way to learn it is just to get started and to buy Pimsleur audio CDs and start listening to it, and then start, if you want to learn how to read it, then you got to start looking at words. You got to start with simple words that you can understand, like whatever, food, money, cars, different things that are going to be useful to you if you ever go to China, right? Like taxi, if you have to write it or say it or whatever, or thank you if you go to a restaurant and you want to put a tip, you say thank you. Then you learn these like basic things first, but it's the more time you spend looking at it. Like for example, the charts, like I was telling you about the open, low, high, close. Well, the more time you spend actually watching, like this is the only reason I would say to watch the 1 minute. I would say the reason to watch the 1 minute is to watch the candlesticks and how they form, so you can get used to seeing price come up, price open, come up, go down, and close, because then it's going to become second nature. It's going to become just something that's just a part of you, and and it's just going to be like reading English in a book. You can look at the charts, you can read it, and you can know what's going on, and that's going to help you a lot. So spending time on the charts, like I said, on the 1 minute chart, just watch price form and stuff like that. Another thing of caution too, I would caution anyone to I would just say be careful around news events. Like be aware when news events are happening, so that you can either not trade or or be waiting, because here's what can happen. What I've experienced is a lot of times when I'm trading, like even if I've got the right direction, what'll happen is I'll try to get the best position I can, and then around the time of the news event, I don't know if it's on purpose or why they do it, but a lot of times price will move back down to that danger zone of where a lot of people got in at, And I think it's like maybe a liquidity trick where they're waiting for that news event to spike so they can hit that liquidity and then move price up. But a lot of times it can be dangerous on certain pairs. Now certain pairs don't spike like that. If you go back and look, so go to Bloomberg or wherever you want to get your news from and look at the past news releases. The reason I say Bloomberg is because they have all the past news release data charted on their thing, and you can actually go and look on the last news release and what it was, and they make it really easy to do. And then you can go back on the charts and look what happened on the different pairs. You know, like, so sometimes USD JPY, like, I think, now correct me if I'm wrong, and I'm sorry, forgive me if I'm wrong, but it seemed like certain pairs don't spike as much around news events. Like, they'll just be here and then they'll just go doo, you know, if it's bearish news or whatever. Now, I'll say like let me say a couple more things. Be aware of the certain things, like, so say you're trading the majors in Forex, the major pairs like US, you know, I trade GBP USD, but there's also Euro USD, USD JPY, AUD USD, USD CAD. I think I said it in the right order. Is it CAD USD, USD CAD? But anyway, watch the US dollar index and keep track of and know what makes the dollar move, because certain things like oil, like, so you may say, this oil news, it doesn't affect me, it doesn't affect Forex or whatever like that, but the price of oil, it does affect the price of the dollar. And the price of the dollar obviously affects not just, you know, the currency pair that you're trading, but all the other currencies, right? Like, all the other currencies are affected because the major Forex pairs all have USD in it. So USD, something happens to affect the price of the US dollar, all of a sudden all the other currencies are affected, and basically, you know, let me explain. So the US dollar index is the value of a dollar weighted, no, the average value of the dollar weighted against all the other currencies that it trades with, right? So what I mean is, if there's news in the US dollar and the US dollar goes up, well, now those other currency pairs are going to be affected. But if there's major news in, say, Great Britain or something that's sort of like contrary to that or whatever, then, you know, that pair is going to be affected in a different way than, say, if there's news that's agreeable that comes out in Japan on the USD JPY. And that's why certain things can be helpful. Like, there's I think the website's called MATAF, something MATAF. Look up currency strength index, MATAF. Just Google that, MATAF. Anyway, there's something, and I've got it on one of my videos that I show. Maybe I'll make another video on it or whatever, but it shows all the currencies on one graph, one chart, and you'll see like most of them are kind of going together, but then you'll see like one goes up and then one goes down, and like, or maybe two go up and then two go down, like that. But the rest of them are kind of going in sync with each other, and there's always going to be like an anomaly pair, and that's the one you want to look at, because that's going to be most likely the one that's trending. And we all know the best way to make money, or maybe not all of us know, but we should know, the best way to make money in Forex is in a trending market. So the trick is to catch those turning points, those pivot points, to know, okay, which markets are overbought, which markets are oversold, and to catch them at that tipping point where, like, say they're at a major level, like a 1.5 or 1.25 or one of those major levels, well, then you know that's a major level. It's probably going to go hard in one direction or the other, you know. And if the long-term downtrend, if the long-term trend is down, you know, are you going to bet that it's going to keep going down? I mean, what does everything look like? What does the do the fundamentals look like? What's the market sentiment look like? What does the price action look like? What are the formations surrounding it? You know, and this is where all your experience and knowledge are going to come into play in a cumulative way to help you to understand when you need to be selling and when you need to be buying, and the timing. Now, timing is everything. Timing is where you're really going to make your money, because timing will either make you or break you. So timing in the market, it's one thing to know what to do, it's another thing to know when to do it. And so that goes back to what I said about FOMO, fear of missing out, having patience, and you know, and that's just going to come with experience. And that's why I always say, don't risk live money until you prove yourself on demo with fake money in a live market. And I always say, you got to ask yourself this question: are you someone who you would give money to trade whatever you trade, whether it's FOREX or you know, you could trade the US 30 or the NASDAQ or whatever you trade. If it's, I mean, I don't even talk about stocks, but you know, are you someone who would feel comfortable giving yourself money? You know what I mean? Because that's exactly what you're doing when you're trading FOREX. It's like, you put $100 in your account. Okay, now you are giving yourself $100 to trade. You know, how do you feel? But you can see it's not enough to just put $100 of your own money in there. You have to ask yourself, you know, if you were somebody else, how would you feel? How would you feel giving yourself money to trade with? You know, so do you feel like it'd be a good investment? You know, I got it. You're welcome. Do you feel like it would be a good investment? You know, or are you somebody who would just lose it? You know what I mean? So, you know, you have to just get in there and start trading, and just get in there and just get your feet wet and just get experience. Like, you just have to get experience, because, you know, there was you know, before I was spending like all day on the charts, you know, and what I realized was, like, it was really unnecessary. Now, it's important, there's certain key levels that you need to be paying attention at, right? But you need to kind of monitor your trade and see how it's going. Oh, you know, we got in here, like I said, if you're trying to buy, you want to get in ideally below the 1,000 level. Let's say you did that. Let's say you got in below the 1,000 level. Okay, now, did it establish support right here on the 1,000 level? Okay, great. Take another position. Right now, boom. What happens at the 125 level? So the 125 level would be like, let's say you got in at the 1.0. Let's say you got in at the 1.10750, right? So that's the quarter level just below the 1,000 level. Let's say you got in there, it come up, it made support right here on the 1,000 level, the 1.11000, and let's say you bought again there. Okay, there's a level above that. There's a level between all these quarter levels called the 125 level. You want to keep an eye on what happens to that 125 level. That would be like the 1.11025. 1.11125. Actually, 1.11125. So you want to pay attention to what happens there. That's not a major level. You probably don't want to buy there. But if it can get above that, then you know it's probably at least going to go up to the next quarter level. And then you need to see what happens there. Does it establish support on that next quarter level, which would be the 1.11250. 1.11250. And if it establishes support there, you could take another position. Now, be aware, when it gets to that 500 level, you have to watch, and see what's going to happen, because the 500 level, a lot of times what can happen is it can bounce off of there and it can go back down. And so it's up to you. You can take profits there and wait for it to come back down. Maybe it comes back down and rejects off of. So it comes up to the 1.11500 level, and then it rejects off of that and comes back down to the 250 level, right? Okay. Now, remember you took a position there. So not only did you not get the profits from it moving to 1.11500, but now you're risking drawdown if price goes below where you took your entry at 1.11250. Now, hopefully it rejects off the 1.11250, goes up, establishes support. Hopefully it breaks through the 1.11500 level and establishes support there, and then you could take another position right there at the 500 level. But that's going to be about it for you, because the mistake that you can make is, and it's not always a mistake, but a lot of times it is taking positions too high, too close to the next 1,000 level that price is supposed to go to, if it's headed that direction, right? I mean, obviously, but it usually goes and tests all these levels and moves in between these levels. So, in other words, it's good to take a position below the 1.11 level. If you can take one at 1.10750 level, and then again at the 1.11, and again at the 1.11250, and then take one more position if it establishes support at the 1.11500. But after that, you need to just ride it out and wait on take profit, because if you start taking positions at 1.11750 level, price is probably going to come back. Now be aware, because price is probably going to come back to the 1.11500 level, and if it does, no big deal. It's normal, especially on an uptrend. Now I will say this: on an uptrend, it's more likely the price is going to come back and test anything, because price always falls easier than it goes up. Price requires volume to go up, but it just falls on its own weight, right? So if you're in an uptrend and it comes back down, hey, to the 500 level, you're risking drawdown if it goes below. But if it's already established support, and then you bought and then it went up and came back down, hey, relax. It's probably going to go back up. Maybe it dips down below, and you just are in that drawdown, and you just accept that it's a risk that you take. But that's the reason why I say it's better to not trade. If you're trading long, if you're buying, it's better to not take positions above the 500 level, because that's a critical level. It's probably going to come back and test. It might even break through, especially on an uptrend. And you just want to look to let that puppy ride. So hopefully it gets back above the 1.11500 level, and if it comes back to test, even if it breaks down below, hopefully it goes back up, and then maybe establishes support again before it takes off. And then it's up to you if you want to take profits at the 1.11750 level, or if you want to try to get closer to the 1.11 or the 1.12 level. I recommend, especially on an uptrend, you want to probably take profits a little bit lower than where you think, right? So instead of setting your take profit at 1.2 or 1.12, you would set your take profit at 1.11950 or 1.11925, right? So 50 pips below or 75 pips below or whatever. And it's up to you. If you see price start taking off, like if it's thundering up, and then all of a sudden, man, people are about ready to take profit, and I'm almost at my take profit, but then you see price start going, and then it's up to you what you do. If you want to keep an eye out for trend lines, things like that, things that could indicate that price could reject off of, and take your profits. And even if it keeps going up, even if it spikes up, even through the 1.12 level, hey, that's just the game, and you got to be okay with it. You got to be okay with whatever profit that it gives you, and call it a day, because where you can get into danger is when you take profit and you're like, I took profit too soon, I want to get a little bit more out of it, and you start taking a position, and then everybody takes profit, and you just start doing crazy stuff. Like, look, if you got in on the big move of the day and you took profit somewhere at the end of that move, or somewhere where you think the end of that move is, like at that next 1.1, at the next level, with a 1.12 level, that next 1,000 level, then hey, be happy with that, and don't get greedy, and and because most of the time my experience is what'll happen is if you do get greedy, if you do try to get more out of it, if you try to get more than what the market is trying to give you, then what'll happen a lot of times in my experience is you'll start losing money, and then at the end of the whole thing you'll be like, oh man, I wish I'd have stayed out. Because what you want to do is you want to catch these big moves, right? And there's usually a big move every day, or a couple of big moves. Sometimes it'll make like a 500 up down, 500 up down, like that, like 500, 500, 500, 500. Or on the worst days it'll be like 250, 250, 250, 250. But so most of the time you'll get a like a 500 or 750 or a 1,000 move up or down, like a major move, And those are the ones you want to catch. You can make money on the smaller moves, but in my experience, it's better to scale in on the big moves, and just take a large chunk of the profits every day. And kind of like one of the last things I'll say is make sure you take profits, right? So if you're starting with a small account, a $100 account, be happy with $100 profit, right? The name that I use on YouTube is FOREX Money Flipper. FOREX Money Flipper. And there's something to that, where it's basically saying if you double your money, that's a good day. Look, do the math. 100, 200, 400, 800, 1600, 3200, 6400, 1280, 20, 1280, 20, 1280, 24, 25, 2560. It's just, and do it on a calculator. Basically, go to calculator and do 100 times 2, and just keep timing it by 2. And like in a month, if you did that literally in a month, if you literally did that, you risk it all every time, which is, if you can handle that psychologically, you can try it. But in a month, you could have $1 million if you did that. Now, there's certain things with the market, like liquidity. You start running into those types of issues when you're dealing with bigger numbers, with live money, because you can do millions of dollars on demo, and it's not going to affect the market. But you start trading in millions of dollars on the live market, it's going to affect it, right? And so your order might not even get filled unless there's enough liquidity in the market, which is why those big players who are literally trading in millions and hundreds of millions and billions of dollars or whatever, that's why in order to get their positions filled, they literally have to manipulate the market to get that liquidity. And that's something that's important to understand for a trader, because those big players who need that liquidity in order to fill their orders, those are the same people who really make the market move, because it takes a lot of money to make the market move just one single pip, which is 100 points, which on the charts, 100 points, well, let's just do 1,000 points, well, let's say 100 points, it would be 1.11100 between that level and 1.11200. That's 100 points. 1,000 points would be 1.11000. Between that and 1.12000. And 1,000 points is 100 pips, and 100 points is 10 pips, right? Because minus is 0, basically. So 10 pips, or 100 pips. Anyway, it takes a lot of money to move the market. So you got to be thinking in terms of what are these large players thinking? Where are they going to get their liquidity? And that, if you can think like that in the market, and you can think like a large institution, and guess what? Those are the whales. The sign behind me says, warning, swim at your own risk. This could not be more appropriate. No lifeguard on duty when you're trading. hey, there's no lifeguard on duty. It's all you. So it's good that I'm right here by the sign. I like that. But so those people who have to have that liquidity in order to get their orders filled, they are the whales. And you don't want to be a guppy, you don't want to be plankton, but if you can be a shark that swims with the whales, or you can even be a little baby shark and swim with the whales, then that's where you want to be, right? But to swim with the whales, you have to know where the whales are at. You got to know which direction the whales are swimming, right? And that. So anyway, I'm gonna get a swim in here before it gets too late. They start doing swim practice and stuff later, so I want to get in, get some swimming in. This video has been a little bit, it's been a lot of effort to make, so I hope you appreciate it. And that was a lot of information. I prayed before I made this video. I said, God, help me to make the greatest video ever that ever has been made or ever will be made on Forex, and the simplest video that anybody can understand and go out there and make money. So get out there, get after it, start on demo, prove yourself. Once you become somebody who you would give money to, then do that. Give yourself a little bit of money, $100. Once you show that you're consistently profitable and you're making money on a regular basis on demo, then try it on live money. I will say this, trading on live money is different than trading on demo. So what I did was I traded on demo for a long time, and then I traded on live, and then I lost a lot of money, and then I went back to demo, and that's where I am now, because the psychology is different. So once you get some experience on demo, go to live money, realize what that's like, and then now you can go back to demo and actually practice more realistically, because there's things that you're going to probably do if you start off trading demo that you would not do with live money. So once you start trading with live money, your habits will change, everything will change, the way that you trade will change, and then you will, and then if you have to go back to demo, let's say you start losing a lot of money, then you're like, okay, I'm gonna go back to demo because the pain gets bad enough, and and you're like, oh man, okay, I'll go back to demo. And so what happens is you go back to demo, you'll start trading like you were when you're trading live money, except now you'll have more experience, you'll understand how live trading is with live money. So now you can be more disciplined on your demo trading, so that you are basically trading like more realistically. So now you can get even better experience, and that's what I'm doing currently right now. Because I'll give you an example. Because when you're trading at first on demo, what you might end up doing, you take a position and then you'll get into drawdown. You'll take another position and then you'll say, oh no, I'm almost at margin call. Let me put in a little bit more money because it's just fake money. It doesn't matter. So my margin, I have enough margin, and then when it gets up above there, I'll close that position, and then I'll just have this position and stuff like that. And you'll manipulate different things, and you'll trade in a way that you wouldn't trade with live money. And so if you start trading with live money, it's like you take a position. Well, once you get into drawdown, you're like, oh man, I lost $25. What you got to realize is that $25 is gone. So if you take another position and it continues going down, now you're double damaged. I always say, don't double down, double up. And that's part of the other thing I'll tell you, is back at that 1,000 level, if you can get in below there, like I said, and it goes up, now you're in profit, so now your next position is a little bit risk-free, in a way, because you're like, say you're at $25 profit, so you take a, say you take a, so you've got a $100 account, you take a 0.1 position at the 1.10750 level, and then it goes up to the 1.11000 level. Now you're at like $25 profit. Now you can take another position, and if it goes into drawdown, even if it goes all the way back down to the 1.0750 level, you're still at break even. But if you take another, so you take another position there, but if it goes up to the 1.11250 level, now you're at like whatever, 50 plus 25, $75 profit. Now you take another position up there at the at the if it establishes support on the 1.11500 level, and you got to be careful. You got to wait for it to actually. What you need to do probably is wait for it to come back and test that level. See, if you're going to take a position, what you typically need to do is wait for it to come back and test. It will not always come back and test, and that's why sometimes you just got to jump in. That's up to your discretion, your experience, and market variables and different things like that. But so you can wait for it to come back down and test, and wait for it to go back up and set support, and then come back, and then wait for it to come back and test, and then you take another position. Now, like I said, at that 1.11500 level, now you're at $75 profit. You take another position, and then that's it, right? Remember I said you don't want to, and when you're doing longs, you don't want to buy above. Typically, usually you don't want to buy above the 500 levels. It's just more risky. You can if you want to, but like I said, it's more risky because if you take a position at the 1.11750 level and it comes back down and tests the 1.11500 level or even below that, which happens, then you're in serious drawdown. So it's best just to not trade unless you didn't take a position up there and it already come back and tested and did all that junk, and now you're like, okay, now it has to be going up because it's already done all that other stuff. Now then you might take another position at your own risk, but what I'm saying is you're creating money to trade with as you go, right? And don't forget to take profits. And anytime you double your account, it's a good idea to start thinking about when am I going to take profits, and you want to keep an eye out for your take profit zone and how it's looking, how price is behaving, whether you think it's going to hit it or not, what the momentum's looking like. And as far as indicators go, like I said, volume is important because you want to look to see like for an uptrend, what will happen is you'll have higher volume while it's going up, and then when it comes back on a pullback or a correction, it'll be lighter volume, especially in an uptrend, because like I said, for it to move up in the first place, it has to have higher volume than for it to move down. But like when it moves down, like a pullback or correction, it should always be on lighter volume. Even on a downtrend, it should be heavier volume on the downtrend and then lighter volume on a pullback or a correction. That's how you kind of can gauge what what direction the market may continue to go in, right? So volume, the stochastic oscillators are good to use. I like to use the multiple time frames, so I'll use like a H4, H1, 30 minute, a 15 minute, a 5 minute, and sometimes I'll look at the 1 minute. But those are the two that I use. And then another one that I just started using, which I think is helpful if you can understand it and you can get used to it and you can really get good with it and get good at reading it. Just like everything else in Forex and in life, but is the on balance volume. And I'm not going to talk about that here because I don't really fully understand it, but I know that it's supposed to be got to do with like volume combined with like the open orders. No, it's a special way to measure volume, on balance volume. I don't fully understand it, but it's something to do with it's supposed to be better correlated with the trend. But I use both. I use stochastic oscillators, volume, and on balance volume, and also I use what do you call those moving averages. So I use like exponential moving averages. I think I use like the I don't know, maybe like the 200, 100, 50, 25, and the 10 or something like that. I've experimented with a lot of different exponential moving averages, but like I used to experiment with the 365, the 180, the 90, the 30, because I just figured like we'll just divide the days up, right? You got the 1 year, the 6 month, the 9 month, and the or the 6 month, 1 year, 6 month, 3 month, or is it 9? The 1 month, 1 year, 6 month, 3 months, 1 month, and then like whatever, 2-week, and then the weekly. But yeah, just dividing all those in half. But there's a lot to learn. 2 books that I recommend that you get to read are this book right here, Technical Analysis of Financial Markets. Just start with that one. And then there's another one too. You may want to, it's more advanced. It might, but definitely you can learn a lot from it. The Wyckoff methodology in depth. Anyways, that's the video. I gotta go, but hopefully you enjoyed the video. Hopefully it was helpful to you. And yeah, thanks so much for watching, and we will see you later. All right. Thank you.